Hello and welcome to another episode of the Of Interest podcast. I'm Gareth Vaughan and today's guest is Grant Spencer. Grant is Adjunct Professor at Victoria University's School of Economics and Finance. Prior to that, he was Deputy Governor and Head of Financial Stability at the Reserve Bank from 2007 until September 2017, and then he was Acting Governor during the 6 months up to March 2018. Grant, thanks for joining us. We really appreciate your time. Now, Grant is here to talk about the hottest economic topic of the moment, which is, of course, inflation. Look, Grant, I thought a really interesting point to start with was looking back to your last official cash rate, review when you were in the role of governor back in March 2018. Now, it presents I've got the statement in front of me, and it presents a very different world to the one we're now living in. With consumer price index inflation running at an annual rate of just 1.1% then. Of course, now we're at 6.9%, and we're expecting that it will probably rise higher even from there. So look, we are hearing a lot about price rises at the moment, and everything from food to mortgage rates, rent, petrol, of course, is a favourite, building materials, and pretty much anything else you can think of. So I just thought if we start back, looking back though 4 years, I mean, a lot has obviously changed in the world. So, what, in your view, has really happened to cause this big spike in inflation that we're now seeing?
Well, thanks, Gareth, and it's a pleasure to be here. Back then, I mean, we had, a very long period of low inflation and declining interest rates. It was really that period right back from the global financial crisis, and it was a period of stability in prices, stability in interest rates, and really, now it's all changed. And of course, the main trigger was the advent of COVID back in early 2020, and I guess what we had then was we had this big supply shock, and at the same time a very big policy reaction. So inflation is always driven by persistent excess demand, and in this situation over the past 2.5 years, I guess now, we've had persistent excess demand resulting from an adverse supply shock and expansionary demand policies, in particular monetary policy and fiscal policy. So the initial supply side, obviously, the shock was the result of the lockdowns that happened here and in many other countries, and they gave rise to rigidities in both labour markets, material markets, capital goods, shortages, price increases, and then at the same time the governments were out there saying, right, we need an emergency response. So we had fiscal actions. Here we had, of course, the wage subsidies, range of policies around the world. In the US, you had this helicopter money where everyone just had a check in the mail. So a lot of money coming into household bank accounts. At the same time, you had the central banks saying, okay, this is, we need to move to sort of crisis emergency settings. Interest rates were already quite low, and they would drop to zero, and in some cases even negative. We had a big step up in quantitative easing, credit easing, forward guidance. So basically pulling out all the stops to try and soften the impact of these lockdowns. So that excess demand pressure, I mean, I'd say initially it was felt mainly in asset markets. So, right from really, equity markets were picking up from sort of mid-2020. And then you've had the housing markets moving up, and of course last year we had a real housing market boom. Most of that based on very cheap finance. And increasingly at the same time, you had inflation coming through goods and services prices and starting to sort of permeate through the system, affecting wage increases, affecting inflation expectations. So the policies, you say, well, the emergency policies were actually pretty successful because they stopped the sort of potentially drastic economic downturn that everyone was predicting early on in 2020. So unemployment rates did not go up to the levels that were feared. Growth didn't fall apart. And so the policies were successful in moderating the impact of those supply shocks. But the problem was that they kept the easy policies for too long. And despite the fact that the economic recovery, was stronger than expected. So, while that was happening, we again had then the further supply shock earlier this year of the Russia's invasion of Ukraine, which persisted or perpetuated the supply side impact, higher oil prices, high energy prices across the board, and also you've had this situation in China where the Chinese policy of zero COVID, has perpetuated a lot of the supply chain disruptions that had happened earlier on, and everyone expected, well, those would sort of clear out once COVID was coming to an end. But, that's again has been perpetuated. So the story that the policymakers were giving sort of through last year, that this was these price increases were temporary, transient, we just hang on and we just need to sit through this and eventually they'll go away. That wasn't happening. And so the policymakers realised that, in fact, they had a bigger inflation problem on their hands than they had reckoned for, and that they needed to do something about it. So, Reserve Bank of New Zealand started tightening, October last year, which was late in the piece, but it was earlier than most of the other central banks, which have only just got started. And now they've realised they're sort of behind the eight ball. They're really tightening with a vengeance, and as we saw last night with the Fed.
Yeah, the Federal Reserve obviously going 75 basis points. Look, that's a great explanation, Grant, of what has happened in the last couple of years. I think just sort of casting my mind back to March 2020, I just remember as COVID was sweeping the globe and we were watching countries around the world go into these things called lockdowns, and cases were sort of popping up in New Zealand. The financial markets were going haywire, and it sort of did almost feel like the world was ending. And so obviously, as you've described, policymakers, be they central banks or governments, responded very, very aggressively, and there were those terrible forecasts of double-digit unemployment and huge falls in house prices and all these types of things. I'm just wondering, you've described that monetary policy response, which of course in New Zealand was reducing the official cash rate down to 0.25%, a record low, and then that large-scale asset purchase program, or the QE, where the Reserve Bank bought ultimately $53.5 billion worth of New Zealand government and local government bonds in the secondary market off banks. We saw that. And with the government, the fiscal policy response, which was obviously the government spending money to try and influence the economy, which you highlighted, the wage subsidy scheme. When did it become apparent to you that perhaps these policies had worked very well and perhaps ought to be dialed back?
Yeah, well, that's a good question. And, in my view, if you go back through the economic indicators, the the first signs that things were not going to be as bad as expected was really just late in 2020. And if you think about the market indicators, some of the market prices as an indication of expectations. I think it was around September, October 2020 when the bond market, when bond rates, interest rates that had been falling, started to move up again. And that was in response to emerging economic indicators both here and internationally, which were saying, the outturn for real activity in the global economy is not going to be as bad as we thought, and unemployment's not going to be as bad as we thought. And there was a period there, you might recall, when the Reserve Bank of New Zealand was talking about the possibility of negative interest rates. And at that point, which was around mid-2020, the term interest rates were still falling. But then as we got later in the year, the indicators came through, and that negative interest rate thing in New Zealand just was taken off the table. So no, well, that's clearly not going to be needed. So that's when the information flow started to actually turn. So, yeah, I would say the first signs of it, and when policymakers in the central bank should have been thinking, what is this telling us? They clearly stopped talking about negative interest rates, so clearly their mood had changed, but they kept it at the 25 basis points for another year. So, my argument would be, well, through that period they should have been thinking about moving back gradually towards a more neutral position, rather than waiting until the end of 2021. And of course, different countries had different sets of indicators. But I think, that shape of the trend in bond rates, was generalised across the major markets. It wasn't just New Zealand. So that's when the information started to turn.
Now, in terms of the actual inflation picture, I'm really interested in I guess the information that you get when you're at a central bank. And a personal anecdote that I experienced, which at the time really surprised me. So this is January 2021. It was the school holidays, and my youngest son had a friend round to play, and his dad came to pick him up. And the father works with the freight industry. And we sat down and had a beer on a January afternoon as the kids were playing, and he said, when's the Reserve Bank going to do something about all this inflation I'm seeing coming through? And I just said, what? What are you talking about? This is January 2021. And now, I'm just curious. Obviously, when you're in a central bank, you've got all sorts of data coming from everywhere. Are you hearing anecdotes like that from people as well?
Well, it was clear there were price increases around the place, and a lot of them were due to these constraints in labour markets and in material markets, supply chains, etc. So the key is, the interpretation of that so-called inflation, price increases. Is this a temporary shock, supply-side blip, or is it something that policy should respond to with a generalised firming of policy? And that's always the nature of the discussion. And it's very easy to sort of be biased in one direction and just sit pat until you've got a convincing case that overall, core inflation or underlying inflation is moving, therefore we need to move. So it's difficult for policymakers to turn policy, because as soon as you turn policy, the markets will expect that you're going to continue to tighten, and the whole shape of the interest rate curve will change, and you can have a significant effect on things just by that decision to sort of start to make one increase rather than being on an easing mode to start.
And even just a comment from a central bank governor can have that effect, can't it? Sometimes.
That's right, it can. So that's why they're nervous about shifting from easing cycle to tightening cycle until, they can see the whites of the eyes of inflation. But that's also the challenge, because as it's turned out, they've tightened. They really should have been tightening earlier. Well, they should have been moving back to neutral. And this is the thing, is that the default should be seen as neutral, not as super easy.
And by neutral, we're talking about an official cash rate that isn't stimulating or restricting the economy, isn't it? So where would you see a neutral OCR now?
Well, that's right. The idea of neutral is just in driving a car, that, you haven't got your foot flat on the gas and you haven't got your foot on the brake. It's a pretty sort of nebulous concept, so there's no precise number. But presently, the Reserve Bank itself thinks that neutral is around 2%, around the 2% OCR, and that's probably, a reasonable guess. There's no point. Different models will give you different measures of neutral. It may be a bit higher than that, but it's sort of the concept that's important. You know if you've got super easy policy, you should be moving back towards neutral if you think that things are starting to change, and that you shouldn't be just focused on one of those objectives, one of the dual mandate objectives.
So in terms of, you noted that the RBNZ did begin increasing the official cash rate in October of last year. The Federal Reserve in the US didn't start until March of this year, and they're obviously now moving in big steps. When do you think they perhaps should have started moving?
Well, I'm not sure. I don't have a date for them, but clearly they should have been starting earlier. And they should also probably have been thinking about the fiscal stance earlier as well, because, for example, in the US there's still a very easy fiscal policy, so that the initial fiscal injection back in 2020, that was perpetuated through 21, then another package earlier this year. So that's going to make the challenge more difficult in the US, having fiscal policy still pretty easy and being late starting with the monetary policy tightening. And, they've also got an issue with a very tight labour market and a lot of wage pressure that's persisting, and therefore underpinning those inflation pressures.
We've discussed a bit about the supply chain disruptions that we saw with COVID, and obviously Russia's invasion of Ukraine, and obviously with Russia being a big oil producer and gas provider, and also both Russia and Ukraine being big food exporters, that has caused a new round of inflation in energy and food markets. Things like fertiliser too are impacted. So, you could say we have had a bit of a perfect storm in the last couple of years. Do you think that's fair?
I think it probably is fair. That's right. It's a very difficult situation to manage through. And when you're looking at policy today, when the Reserve Bankers, they have to be a big question about, well, how long are these supply shocks going to last? How long is the Ukraine war going to last? What assumptions do you make about some of these supply side effects, like the price of oil? It could well be that the price of oil goes up further through to the end of this year rather than coming off, as the Reserve Bank is forecasting. So they have to make assumptions, but things could easily get worse before they get better. And in fact, I think I was reading something last night about the Russians reducing their supply of liquid natural gas to Western Europe through the pipelines. And so there's still this, political tussle going on between Europe and Russia, and, how these sanctions are working, whether they're going to get tougher, and whether Russia is going to come back with sort of countermeasures by restricting supply.
So that moves us on nicely to the million-dollar question or the billion-dollar question, Grant. Now that the inflation genie is out, how do we get it back into its bottle? I mean, is it just a matter of central banks increasing their, official cash rate equivalents, or is there more we need to be doing?
Well, it's a pretty blunt tool, as you know, monetary policy. I mean, they are truncating their quantitative easing, so most central banks now are sort of moving to some form of quantitative tightening. But they're putting that in the background, and rightly so, in my view. So they're trying to sort of put that on autopilot, so it's not a major factor that markets have to contend with. In the meantime, the main tool that they're using obviously is their official cash rate, and they're moving that up rapidly and giving every indication in their forward guidance that it's going to move up significantly further. It's sort of 3.5–4% is the territory that central banks are indicating the official cash rates will have to get to. So that forward guidance is affecting the term structure of interest rates, and that will weaken domestic demand. It will work through the various transmission channels, through wealth effects, through sort of income effects on investment, etc., to bring domestic demand more back into line with supply and therefore reduce the inflation pressures. They're sort of hopeful that because inflation expectations are still relatively favourable when you look further out, that it may not be as tough a task as it was, back in the sort of 70s, 80s, when central banks were grappling with really embedded inflation. So there is some sort of hope in the sense that longer term expectations are still, down in the 1 to 3% range. My view is in the New Zealand situation that really domestic demand could weaken quite quickly, because it's always been very closely linked to the housing market in New Zealand. And as you know, the housing market is falling rapidly. It's going to have flow-on effects into residential investment, because developers' margins are shrinking rapidly as their material costs are going through the roof and the prices at which they can sell a house is falling. So, I think that residential investment could slow sharply. Plus you've got the weakening of consumption from, wealth effects, the interest rate effects, mortgage rates. People are going to be rolling off, 2.5% mortgages onto 5% mortgages. That's a significant bite into their effective disposable income. So if you get some assistance from the supply side, in other words, we get over the sort of China-Ukraine effects, then you could see quite a sharp fall off in inflation if you have the supply side working in your favour and the weakening of domestic demand that I was talking about.
So ideally,
I think it could be quite a people talk about soft landing, hard landing. I don't think it's going to be a soft landing. I think it could be a hard landing, but it may not be long lasting. It may not be so traumatic.
So you may not have caught it just before we started recording, but the March quarter GDP, gross domestic product figure, came in at 0.2. Sorry, it was down 0.2% for the quarter. So I just wonder, are we looking at potentially a recession, which obviously would be 2 consecutive quarters of negative growth, and potentially worse? Is the best 2 things that could happen? Would they be Vladimir Putin pulling out of Ukraine and perhaps China ending zero COVID and opening up all its ports again and everything like that?
Yeah, well, that's what I mean by getting over these supply shocks would be a great sort of trigger for a turning point. Plus weakening domestic demand, plus falling oil prices would be a great, a positive move in terms of getting on top of inflation. But I think we could easily see a technical recession of a couple of quarters of negative GDP, and I think the economy. It's pretty hard to not see it. A weak economy next year, through this later this year and into next year.
Yeah, and so we're probably looking at rising unemployment as well. I mean, that's obviously very low historically at the moment, with the official figure of just 3.2%.
Yes, so the Reserve Bank, I think they have it, going up to 4 or 4.5% or something of that order, and I think most central banks are, forecasting relatively moderate increases in unemployment. But I think it'll depend a lot on the flexibility of wages. If wages sort of try to keep up with the current very high level of headline inflation, then that's going to be a real problem in terms of the difficulty of getting inflation down, and the policy will have to be tighter for longer, and unemployment would have to go higher. So the key to a softer landing in terms of the labour market is really having that real wage flexibility, where wage earners are not fully compensated for the big headline increases we're seeing now in the CPI. But that will be a function. It will vary between countries. It'll vary depending on the tightness of the labour market, etc. I think essentially the Reserve Bank here is that real wages will take a bit of a hit in order to accommodate that adjustment. Hopefully that turns out correct.
Look, I think we've talked through really in detail the specific issues in the world at the moment that are causing inflation. I'd just be curious, just in terms of to wrap up. Obviously, we cast our minds back to March 2018 and that post-global financial crisis period that ran up until COVID hit with price stability. We're now in this period of higher inflation. Longer term, what's your expectation? I guess one thing that I'm curious about is we're going to be looking to move to we're looking to mitigate the impacts of climate change, and a net carbon zero economy is part of the agenda there, and there are quite a few expectations around that could be inflationary. So do you think sort of medium to longer term, are we now in a period of higher inflation?
I don't see any reason for that to be the case. I mean, we've obviously had a disruption now, but I think central banks generally are still focused on, more or less 2% inflation targets in the long term, and they have the tools and ability, if they maintain their independence, to achieve that. Now, you're always going to have disruptions along the way, and you can have big relative price movements, and we may well see that in the energy sector, with the relative price of energy increasing as we go through this sort of difficult transition to sustainable energy. Those things are always going to happen through history in different sectors, and I think you're right to say that it could be a rocky road for energy prices over the next sort of 10 years. But I see that as a separate issue to overall underlying inflation, which central banks, if they do their job properly, they should continue to deliver low inflation in the long term.
Well, look, Grant, thanks a lot for that. That's Grant Spencer, who's Adjunct Professor at Victoria University's School of Economics and Finance and former Deputy Governor and Acting Governor at the Reserve Bank of New Zealand. And I'm Gareth Vaughan. This has been another episode of interest.co.nz's Of Interest podcast.